It was not a good end of the week on Wall Street. The Dow Jones dropped more than 900 points.
Yeah, the NASDAQ and S&P are also in the red. The NASDAQ capped off its worst month since 2008, down today more than 4%. Rough day. S&P is also off more than 3%. Joining us now to talk about this rough day, Megan Cassella. She's an economic and policy reporter for Barron's magazine. Megan, welcome. What is driving the market today? How did we get into such a rough waters today?
You're right that it's been a tough month. It's actually been a tough 4 months for the markets, a tough start to the year, really. The NASDAQ in particular is really tech heavy, and it's really being dragged down by Amazon in particular, Apple as well, both reporting earnings. Amazon's earnings came in well below estimates this week. And they were reporting higher labor costs, higher transportation costs, higher fuel costs across the board. So their outlook doesn't look great either. It wasn't a great quarter for them, and they're not forecasting that things are getting better anytime soon. Apple had similar problems. They're particularly citing slowdowns in China, continued shutdowns and uncertainties there due to COVID and ongoing virus outbreaks that are shutting down factories and hurting supply chains. So they're also forecasting a tough outlook over the next quarter or so. Between things like that, the ongoing war between Russia and Ukraine, inflation continuing to come in at a 4-decade high. We're seeing slowdowns across the board, and it's sort of no surprise that investors' mood is a little bit dour.
Yeah, but always a shock when it actually happens. So the core personal consumption expenditures price index, never really heard of that before, the full disclosure. A tool used by the Federal Reserve, apparently, to gauge inflation. It slowed from 5.3% in February to 5.2% in March. Do experts believe that price increase may have peaked?
Yeah, it's a tool to measure inflation. The more often cited one is the CPI, the Consumer Price Index, but the Federal Reserve in particular always follows the PCE, as you mentioned, which came out today. It's really encouraging to see a slowdown there. It's not a significant one. It's 0.1%. But, at least it's something. Do experts believe inflation has peaked? The jury is sort of still out. Some certainly say yes. Some people say we were really starting to see these massively high inflation numbers in May, June of last year. That's when used car prices were really spiking, new cars as well to a certain extent. And so something that economists call base effects is just that when we're comparing prices to a year ago, we probably aren't going to be rising quite as quickly as we were last May and June. So maybe it looks like things are slowing down. On one hand, that's a good thing. It's progress. On another hand, it doesn't mean that we're really out of the woods. If prices are continuing to rise month over month quite rapidly, they're still rising faster than wages, for example. It's still hitting consumers and hurting consumers. They're spending more than they're making right now, going down into their pandemic savings, which they can do for a while, but it does mean that the economy is really hot. And we might hit, I would call it a plateau more than a peak, because we might remain pretty hot for a while.
Well, so in your latest article, you emphasize that Americans should not panic, despite the Commerce Department's reporting that the economy shrank last quarter for the first time since the pandemic hit. What's with this reassuring tone?
It's again, throughout the last year or so, I would say we've seen a lot of really mixed indicators from the economy. Some things are looking pretty strong. The labor market, for example, is really, really hot, which is both good because people can get jobs, bad because it might mean that wages are rising too quickly for the economy to keep up. This GDP report that we saw, which measures how fast the economy is growing, we got a surprise shock yesterday when the data came out that economists thought that the economy was growing really slowly at roughly a 1% rate in the first quarter of the year, and it actually was shrinking at a more than 1% rate. So it looks really bad. That's not what we want. Things are going backwards. But when you sort of dive into the report a little bit, the reasons for the slowdowns aren't necessarily really bad when you're thinking about the fundamentals of the economy. One reason was just that imports surged. Americans were buying a lot of goods from overseas. And part of that is because the U.S. economy recovered faster than some foreign economies did. And so people were buying a lot of goods still. Supply chain issues in some areas were easing and people were able to buy those products. That's not a horrible thing, but it does show up as a negative in the GDP calculation. Another thing is just inventories. Companies had really built up their inventories in the holiday season last year ahead of holiday sales, thinking that it would take them a while to restock because of supply chain issues. So they did all of that early. that meant that propelled growth in the fourth quarter of last year. But again, because we're comparing to the quarter before, in this quarter it showed up as a really big drag. But if you're looking at the things that are most important, if you're looking at consumer spending and business investment and things like research and equipment, those were really, really strong. And that's a good sign, and that's part of why economists don't believe that will continue shrinking into the second and third quarter. They expect things to turn around.
Seeing the bright side.
Oh, yeah. Wow, Megan, the big
Thanks
picture.
for that on a Friday. Yeah.
I know, the big picture and all the details. Important to get the details. Megan Cassella.
Thanks, Megan.
Thank you so much.
Thanks for having me.